2018 to 2020. Trump's trade war with China. Tariffs on hundreds of billions of Chinese goods. Headlines screaming about standing up to Beijing. Both parties talking tough about bringing jobs back home. The entire political establishment united in saying, we're finally going to fight back against China. And in those exact same years, BlackRock, JP Morgan, Goldman Sachs, and the rest of Wall Street quietly moved $1.4 trillion into Chinese markets. Not $105 billion, $1.4 trillion, with a T-peak year, 2020, the absolute height of the trade war. Now, you might think this was a mistake, bad timing. Maybe Wall Street got caught off guard by the politics, right? Wrong. This was the most predictable move in modern financial history, because there's a pattern that's repeated itself for over 300 years, a pattern so reliable, so mathematically precise, that once you see it, the entire story of what's happening to American economic power right now becomes crystal clear. And we're in stage 3 of 4. The global financial system isn't random. It isn't chaos. It runs on a 4-stage mechanism that's destroyed every single reserve currency in recorded history. Stage 1, financial elites create a monopoly on money printing through a central bank. Stage 2, they use this monopoly to finance government expansion through debt. Everything looks great. Economy booming, empire expanding. Everyone thinks they've figured it out this time. Stage 3, the system overextends. Currency starts losing value. Government loses control. Cracks appear. Stage 4, and this is the crucial part. The same people who built the system move their money to the next rising power before the collapse is obvious to everyone else. The population gets left holding worthless paper. We've seen this in Britain, in Germany, in America after 1971, and it's happening again right now as Wall Street pours money into China while Washington puts on a show about getting tough with Beijing. Britain's at war with France, running out of money. A guy named William Patterson comes up with a brilliant solution: create the Bank of England. The deal? The bank loans the government $1.2 million at 8% interest. But the real genius isn't how it works. The government creates debt. The bank turns that debt into money that circulates through the economy. And the wealthy subscribers to the bank, they collect interest on the nation's entire money supply. Stage 1 complete. Within 4 years, Britain's national debt explodes from 1.2 million to 16 million. By 1815, after financing the Napoleonic Wars through continuous money printing backed by government debt, the debt hits $885 million. The lenders didn't just profit, they owned the British government. Stage 2 kicks in immediately. Britain builds the world's largest navy, colonizes half the planet. The pound becomes the global reserve currency. International trade runs on British pounds. Foreign governments hold pounds as reserves. Everything looks unstoppable. Britain's on top of the world. But here's what most people don't know. By the mid-1800s, the cracks start showing. British industrial production peaks and begins declining relative to Germany and America. The cost of maintaining a global empire grows faster than Britain can afford. The debt starts climbing again. And this is where it gets interesting. The same financial institutions that built the British system start moving their money to America. British capital pours into American railroads, American steel, American industry. The Rothschilds finance American expansion. By the time Britain officially abandons the gold standard in 1931, by the time the pound collapses as the reserve currency, the architects have already rebuilt the exact same system in New York. They moved the money before the collapse. Stage 4 executed perfectly. Second example, Germany after World War I. The Treaty of Versailles hits Germany with 132 billion gold marks in reparations. Massive debt owed to the Allied powers. The Weimar government faces a choice: raise taxes to pay it or print money. They choose the printing press. The Reichsbank, Germany's central bank, starts monetizing government debt, paying striking workers, funding social programs, keeping the political coalition together. When France and Belgium occupy the Ruhr industrial region in January 1923 to seize coal and force payment, Germany's response: pay Ruhr workers to strike. Pay them with printed money. The money supply goes absolutely insane. May 1923, 8.6 billion marks. June, 17 billion. August, 669 billion. November, 400 quintillion. By November 1923, $1 buys 4.2 trillion German marks. A wheelbarrow of cash won't buy a newspaper. Workers get paid by the hour because their wages are worthless by the end of their shift. Prices rise during working hours. The middle class gets wiped out. Savings evaporate overnight. And here's the part they don't teach you. This wasn't accidental policy failure. Rudolf Havenstein, the Reichsbank president, deliberately bought foreign currency with marks at any price, regardless of inflation. The government claimed this was necessary to pay reparations. British and French advisors said it was deliberate currency destruction. Later records confirmed it. The hyperinflation was useful. It eliminated domestic war debts. It destroyed the politically inconvenient middle class. When the crisis peaked, when Germany introduced the Rentenmark in November 1923 to stop the bleeding, the solution required American loans. The Dawes Plan of 1924 brought Wall Street into Germany to restructure everything. U.S. money flooded in through the late 1920s. American banks and corporations gained massive exposure. Then, when that system collapsed in the early 1930s, creating the conditions that brought the Nazis to power, those same American financial institutions were already positioned for the next phase. Same pattern, different century. Central bank monetizes government debt. System expands through inflation, currency collapses, foreign capital restructures during the crisis, then exits before the political disaster. Third example, the one that created today's system. Bretton Woods, New Hampshire. Representatives from 44 nations create a new monetary order. The US dollar gets pegged to gold at $35 per ounce. Every other currency pegs to the dollar. Foreign central banks can redeem their dollars for physical gold at that fixed rate. The dollar becomes the global reserve currency, backed by the largest gold reserves in history at Fort Knox. For 2 decades, it works. Europe and Japan rebuild. The dollar circulates globally. American economic dominance is total. But then the US starts using its ability to print the reserve currency to finance the Vietnam War, the Great Society programs, the Cold War military buildup, all without raising taxes. The Federal Reserve expands the money supply. Interest rates stay low. The economy keeps growing. Dollars flood into foreign central banks as America runs bigger and bigger trade deficits. By 1971, there are way more dollars circulating than the US has gold to back them. France sees what's happening. Under President Charles de Gaulle, they start demanding gold for their dollars. In August 1971, President Georges Pompidou sends a battleship to New York to collect French gold. Switzerland leaves the system on August 9th. On August 11th, Britain asks for $3 billion in gold moved from Fort Knox to New York. Paul Volcker, then Undersecretary of the Treasury, said later that when Britain, the country that founded the system with the US and fought to defend their own currency, started taking gold for dollars, everyone knew it was over. By August 15th, only 10,000 metric tons of gold remained in US reserves. August 15th, 1971. Sunday evening. Nixon goes on TV and announces the U.S. is temporarily suspending dollar convertibility to gold. The gold window closes. That temporary measure, still in effect today. The Bretton Woods system collapsed. By March 1973, the world moved to floating exchange rates. The dollar became pure fiat currency, backed by nothing except government promise and U.S. military force in global oil markets. Since that day, the dollar has lost over 98% of its value against gold. In 1971, gold was $35 per ounce. Today, it's over $3,000 per ounce. Same pattern, system overextension, loss of monetary discipline, currency debasement. So now let's apply this to what's happening right now. July 6, 2018, Trump imposes the first tariffs on Chinese goods, $34 billion worth. The trade war officially begins. America's finally going to stand up to China, rebalance trade, bring manufacturing back. Both parties support it. The establishment is united. But July 6, 2018 is significant for another reason. It's exactly 1 month after June 1st, 2018, the day MSCI, the company that controls global investment indices, officially started including Chinese A-shares in its emerging markets index. Think about what this means. When MSCI includes a market in its indices, institutional investors who track those indices must put money into that market. Pension funds, sovereign wealth funds, university endowments, insurance companies, trillions of dollars that simply follow the index. China's weight in the MSCI Emerging Markets Index went from essentially 0 to 43% by October 2020. During the same period, 2018 through 2020, U.S. portfolio investment in China hit $1.4 trillion the peak year, 2020. Trade war at its hottest. BlackRock expanded its Chinese operations throughout this entire period. JP Morgan got approval for a majority-owned securities business in China. Goldman Sachs increased its stake in its Chinese joint venture. These aren't accidents. These are the same institutional structures that operated through Britain, through Germany, through post-war America. And they're executing stage 4 right now. Let's check the boxes. U.S. national debt, $36 trillion. Debt to GDP ratio, 98%. The Federal Reserve's balance sheet was under $1 trillion in 2008. It exploded to $9 trillion during COVID. Still above $7 trillion today. Same mechanism as always. Central bank monetizes government debt. Government spends far beyond what taxes can cover. Currency supply expands way beyond the economy's productive capacity. And the financial institutions that run this process start moving capital to the next power center. Stage 1, Federal Reserve established 1913, monopoly on money creation. Stage 2, decades of debt monetization financing wars and programs globally. Stage 3, system overextended, debt at 98% of GDP, currency debasing. Stage 4, financial institutions moving capital to China while Washington performs theater. We're here right now. The pattern does not care about your political preferences. It does not care whether you believe in American exceptionalism. It does not care about technology saving us, or modern monetary theory, or any other intellectual framework designed to explain why this time is different. This time is not different. The mechanism is mathematical. And when a monetary system is based on debt creation, when the entity that creates money is separate from, but dependent on the entity that taxes, when the system expands beyond productive capacity, the currency debases. And when the currency that debases is the global reserve currency, the architects of that system move their capital before the collapse completes. Here is what people miss. The trade war was theater. It was designed to fail, or more precisely, it was designed to appear as if America was resisting while the actual financial integration accelerated. You cannot fight China with tariffs while your largest financial institutions are moving record amounts of capital into Chinese markets. You cannot reshore manufacturing while the index providers, who control institutional capital allocation, are increasing China's weight in global portfolios. You cannot maintain dollar hegemony while running trillion-dollar deficits, financed by central bank money printing. The contradiction is not an accident. It is the mechanism. The British population did not understand in 1880 that their capital was building America. The German population did not understand in 1929 that American banks had facilitated their hyperinflation cycle. The American population does not understand now that Wall Street is building China's financial infrastructure while Washington performs resistance. But the pattern does not require your understanding. It simply executes. So what do you do with this information? You understand that the machine is already in motion. You understand that by the time this becomes obvious to the mainstream, the repositioning will already be complete. You understand that the current system, the dollar as reserve currency, American financial dominance, the post-Bretton Woods order, is not permanent. It is stage 3 of a 4-stage pattern, and stage 4 is executing right now. You position yourself accordingly. You understand that holding assets denominated purely in a debasing currency is a choice to participate in the transfer mechanism. You understand that the inflation is not temporary, is not transitory, is not the result of supply chain disruptions. It is the predictable outcome of monetary expansion disconnected from productive growth. You understand that when they tell you not to worry, that this time is different, that modern financial engineering has solved the problems that destroyed previous systems, they are either ignorant of the pattern or complicit in its execution. And you understand that the next 5 to 10 years will not look like the last 30. The mechanism is accelerating. The debt cannot be repaid. The currency will continue to debase. The financial elite are already positioned. The only question is whether you understand the pattern clearly enough to see it happening in real time and make decisions that account for the inevitable outcome. This is not prediction. This is pattern recognition. The same mechanism that moved British capital to America in the 19th century, the same mechanism that moved American capital into Weimar Germany before the collapse, the same mechanism that moved capital out of the US as Bretton Woods failed is moving capital into China right now, while politicians argue about tariffs, while think tanks debate decoupling strategies, while the media obsesses over trade war optics. Wall Street has already decided. $1.4 trillion has already moved, and the pattern, which has never failed to complete itself, is 3/4 through its execution. If you want to understand what happens next, if you want to know how the final stage of this pattern completes, if you want to see how the transition from American to Chinese financial dominance finalizes, you need to understand how the machine was built. You need to see the institutional architecture that makes this transfer possible. And you need to recognize that every historical parallel points to the same outcome. The population holds the currency as it approaches zero, while the architects of the system have already moved their wealth to the next power center. That is the pattern. That is the mechanism. And that is what is happening right now, while everyone watches the political theater and misses the systematic wealth transfer occurring behind it. Subscribe now if you want to see how the machine was built, how it operates in practice, and what the completion of stage 4 looks like when it arrives. Because it is arriving. And unlike every time before, this time you have the opportunity to see the pattern while it is still executing rather than understanding it only after the collapse is complete.